Hey everyone, Michael here. So in this video, I want to talk you through the financial health section of the company report. And more specifically, I'll go through the metrics we check and why we check them. And I'll try and share some insights as to what you should look for in the particular graphs and visuals that we show. So for starters though, it's important to note that with the financial health metrics we do check, we have a different set of metrics we check for non-financial institutions and a different set of metrics that we check for financial institutions. And that's things like banks, finance companies, insurance businesses and REITs. So I'll get to that later in the video, but first we'll focus on non-financial institutions. So before I get to that though, why is it so important to assess a company's financial health? Well, ultimately, just like we personally can have assets and liabilities, and we can increase our own risk by taking on more debt than we have in terms of assets, businesses are the same. So they finance their operations through equity or debt. And ultimately, if a company chooses to go down the debt route, as equity holders, that can increase the risks for us because we're not the first in line. So say, worst case scenario, a business goes bankrupt, it's not the equity holders who are the first in line. The debt holders are the first ones in line who get the pickings of like when a company has to sell off its assets. Debt holders are typically the ones who get paid back first. And then if there's anything left over, equity holders can get the rest. So basically, it's worth keeping that in mind because if a company has really leveraged, it has increased its risk significantly. And so in this financial health section, what we try and do is we first assess A, does the company have any debt? And if so, B, is the debt affordable? And so we have visual representations to show you how leveraged it is and if the debt's affordable. And we also have these metric checks that basically break down if the debt is affordable from its earnings. So I'll start with the first two metrics. And that basically, what we check here is the company's short-term assets and its short-term liabilities. And so this is assessing its financial position right now and basically showing you how strong it is in terms of its liquidity to pay its obligations. So the first metric we check is, does the short-term assets cover the company's short-term liabilities? And now short-term assets is things like cash and cash equivalents, basically really liquid assets. And short-term liabilities is basically short-term obligations. So not longer-term contracts, but things like accounts payable and stuff that's due to be paid in less than a year. And the reason why we check that is ultimately because, okay, the company has liabilities due within a year, this much, 80 billion in this case. Does it have enough cash or liquid assets to be able to afford to pay those liabilities when they're due? And in this case, the company has 174 billion. So yes, it has plenty of short-term assets to be able to pay these liabilities. The company would fail this check if it had less in terms of short-term assets compared to short-term liabilities, where you'd be reliant on, oh, we don't have enough to pay all these liabilities within the next year, so you'd be relying on the company's cash flow, or maybe raising some equity to kind of pay its obligations. So that would be a warning sign, and so it would fail that first check in that case. And now the next check we do is the long-term liabilities. So we check if the short-term assets can pay for the long-term liabilities. And again, this is just like a safety measure, right? So like the company has long-term liabilities, and these could be things like long-term contracts, rental agreements, stuff like that. And basically we want to see if it has enough liquid assets on hand, like cash, to be able to pay these long-term liabilities as they come due. And so hypothetically, say some are maturing, then yeah, the company does have the financial strength with its liquid assets to be able to pay them off quickly. So we don't compare long-term assets because when you think about it, that's stuff that's very illiquid. It could be properties, it could be physical assets, just stuff that isn't easy to sell and isn't very liquid and can't be used to pay off debt. That's why we don't compare long-term assets to long-term liabilities, because they want cash. They don't want you to have to, we don't want to see what the business has to sell its long-term assets, because these could be very valuable things. We want to see if it can pay it with cash. And so that's why we compare short-term assets to both long and short-term liabilities. So in this case, the business passes both because it has plenty of short-term assets. Now, the next section we look at here is the company's debt to equity history and analysis. And there's a lot to digest in this chart, so I'll explain the metrics as we go through them. So the first metric we check is the company's debt level. Basically, what we look for here is the company's net debt to equity ratio. So to understand what that means, first it's important to know that a company finances its operations through either equity or debt, right? So debt being it takes on loans and agrees to pay people back, and equity meaning it gives people partial ownership in the business, which is what shareholders are, and doesn't necessarily need to pay them back, but it gives them the form of ownership in the business. And so that's the two sources that a company can seek financing from, right? And there's pros and cons to using each of them. Like equity being like you don't necessarily have repayments to make. However, you are diluting the current shareholders, and you need to like give them an ownership stake in the business. That's a pro con. And as for the debt, you're not diluting shareholders, right? Like you're not issuing more ownership in the business. However, you are now liable to like interest repayments and repayments of the debt, and you effectively now have like obligations, like it's a contract where you need to pay them back. So that increases the risk of bankruptcy. So there's pros and cons to each type of sources, and debt is typically riskier because obviously it's like it's an obligation, like it's a contract that needs to be repaid, and so that's why if a company uses excessive debt, it's pretty risky. It's a pretty risky situation. So the first check we do here is to look at that, like what sources does the company use to fund its operations? And so the check we do here is in regards to its net debt to equity ratio, meaning we take into consideration the company's cash balance as well. And that's because ultimately if a company has heaps of cash on hand that could pay off the debt, then the debt level that it does have isn't that risky, right? So it's got a cash buffer to meet its obligations. So this check here is basically we look at the absolute level of debt. We look at the net debt to equity ratio, and that means it takes into account the cash balance. So a company would pass this check if it had no debt on its balance sheet, for example. So if the company had this red line at zero, where it didn't have any leverage at all. It would also pass this check if the company has more cash on hand than it does debt. And in this case, this company does, right? It has $130 billion worth of cash and $53 billion worth of debt. So it could pay its debt off almost 2.5 times over with just the cash it has on hand. And the next situation would be if the company has a net debt to equity ratio of anywhere below 40%, right? Because that's a pretty conservative level. Like if it's below 40%, it's considered conservative in the sense that it's not using leverage too excessively. So the two ways that the company wouldn't pass this check is obviously if the net debt to equity ratio was above 40%, right? Like if it was using debt pretty excessively and had like a lot of leverage. And the next way would be if the company had negative shareholders' equity. And what that basically means is if the company has a debt level that surpasses its assets, it effectively gives shareholders negative equity, right? So that means if it has a whole bunch of obligations and it's leveraged up really highly, but its assets don't actually cover that level of debt, then effectively shareholders have negative equity in the business. So what that means is if for whatever reason the company went bankrupt and had to pay off all of its, sell all of its assets and pay off all of its debt or people that it owes, it wouldn't have enough then to pay left over to pay shareholders anything, right? So you as a shareholder don't effectively own anything in the business. The company is primarily owned by the debt owners. So that's a really risky situation to be in because it means the company is excessively leveraged and even its assets it has don't outweigh the debts that it has. So that company, in a situation like that, the company wouldn't pass this check and we would give you a warning sign saying it's got negative shareholders' equity. So that's something you really want to keep in mind because a situation like that isn't sustainable and needs to be addressed. The next check we do is about the trend of the debt to equity ratio. So ultimately, you want to see pretty much that the trend of leverage is reducing if they do have debt. So we can see here the check is passed because back 5 years ago it had a debt to equity ratio of about 106%, and slowly but surely the business has been reducing its reliance on the debt. So you want to keep an eye out on this and just basically see that the debt is either reducing or sort of just not high to begin with. That's what you want to look for in this second point. The next check we do isn't in relation to the absolute leverage like we did just then. It's more in relation to, okay, it's got some debt, is it affordable? So this first check we do here is debt coverage. And you can see here, according to this check, it says the debt is well covered by operating cash flow. And so why do we check against operating cash flow? Well, basically, a business has obligations and we want to see if its operating cash flow, which is cash flow from its core business, covers a sufficient amount of the debt that's due. And so we consider anything well covered to be about 20% of the debt. So if operating cash flow from the business, which means it's cash flow from its core business, is more than 20% of the debt, it'll pass this check. If it doesn't, it means that it's a bit concerning because it has a certain level of debt, and ultimately its core business isn't generating much cash flow to then be able to pay that debt if any of it was due. So that could be a risky situation where, say, some of that debt was maturing and needed to be paid. The company's underlying business doesn't have enough cash flow to pay for it, so it might be like, oh, we need to refinance at a lesser favorable rate, or issue some equity to pay off the debt, or use some of their cash balance to pay off the debt. So that's something to keep in mind if you see that it doesn't pass that check, because that's just referring to the affordability of what debt it does have. In this case, the company has a significant amount of cash flow where less than 1 year of operating cash flow could pay for all that debt. So it's very reassuring to know that its core business can pay it off. The next check we do is in regards to interest coverage. So as you know, any debt you take on pretty much has an interest payment that is expected to be paid in congruence with it. And so what we check here is we want to see if the interest payments that are due on the debt are well covered by the company's earnings before interest and taxes. And so we consider well covered anything that's greater, at least 3 times or greater than the company's interest repayments. Earnings before interest and tax has to be at least 3 times or greater than the interest payments. And in this case, it's very, very, very well covered. It's 373 times that. So basically that tells you that yes, it does have leverage, and yes, it is affordable. So if it didn't pass this check, it would tell you basically that the company is having trouble meeting its interest repayments, and that's a bit of a concerning sign. So that's something to look into. And then if you do see that, it's worth looking into like the terms of the debt and the company's ultimately like its earnings growth expectations, if it's maybe just hitting a bit of a temporary downturn or something. But that's something that's very concerning if it can't even afford to service the interest repayments on the debt. So those are the checks that we do in regards to the 6 metrics that you see that contribute to the 6 health checks on the snowflake here. And the last part we have here is basically a visual breakdown of the balance sheet. So if you're familiar with accounting, basically it's a double entry system where if there's anything on the assets side, it has to be made up for on the liabilities or equity side. It's the double entry accounting system. And effectively here we just give you a visual breakdown of all the assets and liabilities so that you can get a bit of an idea of it. And so first you can see here like cash and short-term equivalents, physical assets, which could refer to things like property, plant, and equipment. Long-term and other assets could refer to things like goodwill that they may have acquired, or intangible assets. Receivables is typically, or it is, basically when a company has registered or incurred a sale, where they've registered like, yep, we have incurred a sale, but they haven't actually received the cash flow for that yet. So basically a customer owes them money, and so that's considered an accounts receivable, and basically they're due to be paid in the short term by that particular customer. So it's like a sale's been generated, but they haven't received the cash for it yet, so that's considered an asset here. And also inventory. So in this case with Microsoft, inventory might be like Xboxes it has on hand, or laptops that they sell, any sort of inventory that they sell as part of their business. And so on the other side of this balance sheet is the liabilities and equity. And now it's important to know that a business is basically funding its assets with either liabilities or equity. Liabilities being obligations and debt, and equity being money put in by shareholders. So equity here we can see is $152 billion worth. Other liabilities can refer to just any sort of repayments that aren't considered debt. So it could be other sort of like tax bills due and stuff like that. And accounts payable is the alternative of receivables. So basically these guys have, or this business has incurred an expense, but it hasn't paid them yet. So it has these guys on their books where it's like, okay, we need to pay them in the near future because we have got something from them already. It's an account payable. And lastly, one thing to keep in mind is this debt here. So debt is basically any long-term debt or any current version of the long-term debt plus short-term borrowings. So effectively, when you see debt here, just keep in mind that it's basically financial debt. It's separate from other liabilities, but that's how to view it here, or that's what it entails. And so that's the checks here for the non-financial institutions on the financial health section. What I'll go to now is, just before I get to the financial institutions, I'll show you one more check that we have, but it's for different companies, right? So this check here, cash runway analysis, only shows up in the financial health section of businesses that are unprofitable. So why do we have this check here? Well, ultimately, if a company is unprofitable, it's important to see if, okay, it clearly can't sustain its own businesses because it's not generating a profit. So does it have enough cash to fund itself? And so we have two checks here that pop up in this situation. And this is basically to see if it can afford to fund its operations for the near term. And so we can actually see here this business, which is Roblox, has a stable cash runway and forecast to have a cash runway. So in this case, the company is unprofitable. Like if you look at the future growth and the past performance, it's not generating a profit. However, it has sufficient cash runway in the sense that it actually has positive free cash flow right now. So as you may have noticed from the previous videos we've done, there's a difference between accounting profits and like cash flow profits, and ultimately cash flow is what you can pay down debt with. And so this business has an interesting model where it's got accounting losses, but it has cash flow profits, and it's just the nature of the business. But essentially, it is actually able to sustain its loss-making business, its loss-making nature, because it actually does have positive free cash flow. So as long as it keeps up its positive free cash flow, it can keep going forever. But the thing to keep in mind here is, say it doesn't have free cash flow, what we'll look for is, does it have, like, how much cash does it have? Does it have enough for more than 3 years? If it has a particular negative free cash flow rate, so say it's losing $100 million a year in free cash flow, or losses of free cash flow, does it have at least $300 million in the bank to afford 3 years worth of operations? And if it doesn't, then that's concerning, right? Because within 3 years, the company's going to have to try and refinance by either taking on more debt, or it's going to have to issue more shares and dilute existing shareholders. So that's something to keep in mind. And the next check we do is the forecast of cash runway. So given the companies are currently unprofitable, it actually does have it does have enough cash runway because its free cash flow is growing quite quickly. So as you can see here, the free cash flow is growing by 88% per year. But what we check here is, let's say the business wasn't growing its free cash flow, right? So this business is an example of one that can sustain its own operations, so it's fine, and it passes the cash runway checks. But say you're looking at a business that is generating negative free cash flow, and its negative free cash flow is trending down, what we would do is we would try and look at the growth rate or the trend of that free cash flow growth and see if it's like accelerating or if the free cash flow losses are reducing. And depending on what the trend is, we'll show you basically how it's forecast to be in a couple of years. So in this case, it's growing free cash flow, so it's great. And then there's the other checks as well that we have above. And so the last thing I want to show you is the checks that we do for financial institutions. And as I mentioned, this is the likes of banks, insurance companies, REITs, and stuff like that. So this is different to what we do on non-financial institutions, because if you're looking at a financial institution, basically they typically have a much different balance sheet, in the sense that a lot of their business is generated, or the funding they have is from loans. So when you and I go to our bank and we put a deposit in, the bank will take that and then try and re-lend it out to generate an interest spread on what they're paying us versus what they're generating from lending that money out. And so for the balance sheet health, typically when you look at these businesses, they have huge amounts of debts and loans and leverage, but the way their businesses work, that's pretty normal. And so I've got a business here, JP Morgan, just to show you these metrics that we check here if you're ever looking at one of these types of businesses. So the first check we do is the assets to equity ratio. And basically we want to see how much of the business is being funded through debt or through like its wholly owned funds. And so basically the higher this ratio is, the more concerning it is. And to give you a bit of context, anything below 20 is considered like good. So between 10 and 20 is moderate, and less than that's better. But anything above 20 means there's like a significant amount of leverage, considering how many assets they have. So what you want to look for here is basically just know that the business isn't overstretching itself and over lending and lending out too much money. So in this case, the business passes the check. The next thing we do is an allowance for bad loans. So we want, if you've ever heard of these sort of finance stocks, they all have like a provisions for bad and doubtful debts. And basically it's like an allowance for, okay, we lend out like $100, we're going to have like $2 or so put aside, or at least provision for, to account for some bad loans, because we know that all of that $100, some of those people that we lend to, like say with $1 per person, some of those people that we lend to aren't going to pay us back. So they have to have like a little bit of a balance on the side to allow for those bad loans. And in this case, the business we want to see that it has a provision that's big enough for its bad loans. And you'll see that in their reports that like they may have a bad loan history of like 2% of their loans. And so that if then basically you want to see that they have enough cash on hand to account for those bad loans. And in this case, the business does pass that check. It has 220% worth of what it actually, like the allowance that it has compared to what bad loans it actually does have. It has more than enough cash. So that's good to see. If you see that it's not and it doesn't pass that check, it basically means that like they're underestimating how much of their loans are actually bad. So they're not putting in enough cash or not setting aside enough cash to account for those potential bad loans. So they're not being conservative. The next check we do is low risk liabilities. So we want to see how much of their liabilities are made up of low risk sources of funding. And that basically is like deposits, customer deposits, right? So if I go to a bank and I deposit my money in, that's a source of funding for them. And that's a pretty low risk source of funding compared to if they were to go out and take on loans. So we want to see that the majority of their funding is from these kind of assets, from these sources. And so here, 69% of their liabilities are made up of low risk sources of funding, being like customer deposits. So it's good to see that they are relatively low risk in terms of how they're getting their funding. The next check we do is the loan level. And basically this is to compare its loan to assets. And as you can see here, it says it measures the level of the bank's outstanding loans to its total assets. So like a higher loan to assets ratio could mean that there's higher risk because loans are less liquid than other financial assets. So ultimately, if the business has decided that like it wants to lend out, similar to the check above, if it wants a few above, if it wants to lend out way more than what it actually has in assets, it's not very conservative. So it's like it actually is taking on a fair bit of risk because those assets that it has aren't liquid enough. The loans that it has, they're not as liquid as other financial assets. So it's basically you want to see that it's below 110%. And in this case, the business is actually at 29%. So that's great to see. The next check we do is for low risk deposits. And so we want to see that we want to compare the business's loans that it has compared to the customer deposits. And so for the definition here, it says this measures a bank's liquidity by comparing its total loans to its total deposits. If the ratio is too high, the bank might not have enough liquidity to cover any unforeseen funding requirements. So it can account for any unforeseen funding requirements with its deposits if it really needs to. But if it's incredibly leveraged where it's got so much more, like say it's got 200% loans compared to its deposits, that's a situation where if there's any unforeseen circumstances, it can't use these low risk deposits and try and help itself. So that means it's overstretched. But in this case, it's not. So it's got 45%, which is great, but we typically want to see for anything below 125% because that's like a pretty good level of coverage if it's only like a little bit above its level of deposits. And so the last check we do is for the level of bad loans. And so, as I mentioned above, every business that lends money should have like does have a provision for like what it expects to be bad loans. And so a portion of their loan book is going to, unfortunately, they can't foresee it, but they can sort of expect it. Some of the customers, the people they lend to, aren't going to be able to pay them back. And so they have an estimation for what that amount will be. And they basically, you want to know that the business, in this particular case, a bank, isn't making a whole bunch of risky loans. So if, for example, this level of bad loans was like 5%, that's really high. That means that like only 95% of their loans are safe and they're actually taking on quite risky lending practices. And so we can see here the fact that it's 0.8%, that's great. And we consider anything for a bad loans ratio of less than 2% is good. And so if a bank was conducting really risky lending practices where a whole bunch of its customers were failing on their loans, this metric here would fail, and that means that the business is conducting quite risky loans. So you would want to basically, if you want to do more digging, you could go and look at the business and be like, oh, who are you lending to and why are you lending to them? So yeah, that's the 6 metrics that we check for financial institutions, and also just mentioned before the non-financial institutions that we check. And if a business isn't profitable, we do that cash runway analysis as well. So it's important to check all these because basically like a business may have a great income statement where it's making a whole lot of revenue, it's making a whole lot of profit, but if it's really, really leveraged and like has a whole bunch of debt and it can't afford the debt, or it's having trouble affording the debt, or it's affording it, but it's only just affording it. If there was a certain downturn or any sort of pullback in markets, or the business had a bit of a hiccup, that could cause a lot of trouble. So that's why it's so important to assess financial health, because while a business may look great in its sales, It really ultimately depends on how they're funding their own growth or business operations. So that's why we check these in financial health. And let's just say like the businesses I've looked at are actually quite strong in their financial health. But let's just say you got to the end of one, you're like, no, this business is too risky. I don't want to continue looking at it. I'm going to go elsewhere. You can go to this next steps here and basically explore more healthy companies in the banking industry, or just like this other business here we were looking at being Microsoft, you can explore more healthy companies in the software industry. And basically, healthy companies means strong balance sheet. So companies with a score of at least 4, and then they're ordered by their health. So this will show you all the software stocks in the US that have strong balance sheets. And then you can go from there, and you can see they don't actually these ones don't do too well on the other metrics, but they have really solid balance sheets. So probably no debt at all, if anything. But yeah, that's just how to assess the financial health of a business. And so I hope that's been very helpful with your analysis. Thanks so much for watching. See ya.